What's going on, y'all? This is Chris. Today is Monday, April 6th, 2026. Hope y'all had a happy Easter and got to spend time with family and friends. I wanted to make a video at this point. I haven't made one since early January. January 11th was the last one I made, kind of looking at the whole year and how I thought that would pan out. But as of the last month, we've had some things that have just absolutely rocked those calculations and any type of models that I might have had. So I want to talk about it. Right, as I see, as I have on the screen, we're talking about crude oil today. That's the main point of this conversation: is the crude oil supply shock that's resulting from the ongoing conflict between America and Iran, as well as Israel. Yeah, as they have here, roughly 20% of global crude oil supply is unavailable after closing the Strait of Hormuz. So all of the crude oil that's coming from the Gulf Coast states, so Kuwait, Saudi Arabia, Qatar, Iran, all of these Middle Eastern states, they are not able to get their oil out to the rest of the world, and that again being their primary economic driver is a big problem and a big problem for the rest of the people in the world who can't get that Middle Eastern oil. So it's affecting all markets. It affects everyone who is listening to this, and it definitely is something to be paying attention to. I believe that this is serious just by nature of what is being disrupted at this point. And again, by far the largest oil disruption in history. So we had some major ones in the 70s, not so much in the 80s. 2008, there was a disruption, not a disruption, but you had a run up in oil, COVID. We'll talk about some of those later. But this is by far the largest one that we've had. So I expect the resulting effects to be fairly large. Okay, so what is the Strait of Hormuz? So this is the Persian Gulf, as you see, and then you have the Gulf of Oman on the other side, which basically makes up the Middle East at this point. But uh, if you look at the United Arab Emirates on the bottom of the screen here, as well as Oman, there's this area of land, this peninsula that shoots out into the Persian Gulf and splits the Persian Gulf and the Gulf of Oman, and that's the strait. So at this point, this is where all the traffic from crude oil comes through. They go in here and fill up, and then they leave and then go out to the rest of the world. So this is closed. At this point, Iran, as we see, they are the large border state on the north of the Strait of Hormuz, and they really do control the traffic that goes through there at this point. So, they've basically said at this point, hey, you're going to attack us, we're going to shut this, and everybody's going to feel it. And the good suffers with the bad, doesn't matter. So they shut the Strait of Hormuz at this point, and now tankers cannot pass through. So at this point, we have 20 million barrels a day offline from Saudi Arabia, UAE, Kuwait, like the ones that I named earlier, Iraq. There are other ways that you can get out, get the oil out, and that is via pipeline. But pipeline cannot run nearly as much as a vessel that's holding millions of gallons or barrels, I should say, of crude oil. It's just not going to put a dent in it for any appreciable manner, and that's really only going out in one direction. I know Saudi Arabia has a large network of pipelines, but again, the Strait of Hormuz is the main choke point for the global oil supply coming from the Middle East. So to combat this, there's you got at the bottom here 400 million barrels released, and where is that coming from? So the major countries in the world, they have strategic petroleum reserves (SPRs), and that's basically a level of crude oil that they keep in tankers at some location to be able to use in emergency situations. This would be an emergency situation, right? And what they're doing is slowly bleeding that out and putting that into supply at this point to help kind of backstop some of this $20 million, 20 million barrel per day loss. Now they're not doing 20 million barrels per day. I think they're doing somewhere around in the range of like 2 to 5. But if you run those numbers, 2 barrels a day, 400 million barrels, that's maybe 200 days. And really, I think they're running more like 5. So, I mean, it's more like 80 days at most. So this is not a long-term fix by any means. And by depleting these reserves, again, you deplete the reserves. So you don't really have it as a countermeasure in the future until you refill them. But at this point, this seems that it's remaining closed. I did not listen to whatever announcement that Trump had today. I'll go back and look at it a little bit later. Um, right now, as far as I can tell, this is going to last for another couple weeks for sure, but definitely months. Well, yeah, I would think definitely a couple weeks. I would plan for a couple months just because this is very geopolitically sensitive. There's a lot of moving parts here, and we'll talk about some of those as we go on. As I talked about earlier, I mean, these are the real numbers coming from the IMF, the International Monetary Fund. The first attack was on February 28th. So end of the month, we got to 2 months going into March, and they attacked him. And as you can see, immediately after that, they basically shut the Strait of Hormuz. No tankers and vessels are going through here at this point. You may have like 5 or 10 a day, something like that, but nothing touching the roughly 100 or 90 to 100 tankers that were going through there a day. So that's significant. That is very significant to have that much of a drop off. Essentially 100%. And we'll see that has some real world effects on other countries as well, including America. So this chart right here that I have up, the blue line is the global oil in transit. So this is all the oil that's on the water. It might have filled up in the Middle East or filled up anywhere really, and then it's going to go to wherever its end destination is. But as we can see, in March of this year, it just fell off a cliff. It fell off a cliff and hit low levels that we definitely didn't see for all of 2025, and probably if you go back even farther too. But again, 20 billion barrels. That's roughly 20% of the global oil supply that went offline. And I talked about the strategic petroleum reserves. This red line is the commercial crude. So I think large companies like Exxon, BP, whoever, to operate in America, you have to probably sign some agreement that says, hey, if we ever get into an emergency, we're going to be able to tap into your crude oil reserves to help preserve the country. And that's the exchange that you get for being able to operate on our land. So this is what they have. And as we see, the whole main point of this graph is this is not hit yet. So this hasn't even started to trend down. So they haven't really even tapped the reserves. So we're still in the point where this it's moving in slow motion. It's hit Asia at this point, but it has not really hit the United States. That's why I say things seem to be ever so normal at this point, but I can assure you that they're not. And one of the main reasons being, I talked about a little bit earlier, that this has some real geopolitical implications. Obviously, most wars do. But the petrodollar is one of the main drivers of American, I'd say honestly, prosperity. What essentially happens is all the countries in the world, in order to buy from the Middle East, they are forced to use dollars to exchange for oil. So this is a huge source of demand for the U.S. dollar, which keeps the buying power within the dollar. So again, like I said, countries buy, we buy Saudi crude, or we buy other countries buy crude from Saudi Arabia and the other Middle Eastern states. And the petrodollar basically has two tenets, right? It has two main conditions. Number one, people buy oil in U.S. dollars, and number two, the U.S. will provide protection to the Gulf Coast states, specifically Saudi Arabia, especially. And it's just like this vicious cycle to where, money gets invested into U.S. funds and all this other stuff. So long story short, this is very important. It has really helped to float the U.S. dollar over the years. Since the 1970s, Nixon was the one who made this. The petrodollar is actually one of the first things that I started talking about when I was doing my initial investigations into Bitcoin. Just looking at some of the major drivers around the world and how they tie into finances. And this is arguably one of the biggest, if not the biggest one. And the reason that this is important is because the strait is closed right now, the Strait of Hormuz. But there have been talks in recent, I'd say I've seen in the last week or so, of serious considerations of using the yuan and stable coins, crypto, to be able to pass through the Strait of Hormuz. As a bypass, and people are seriously considering it too at this point, because the stakes are getting dire. They're definitely getting dire, and the more time passes, the more severe this gets. So if you have a situation where you potentially are losing the petrodollar, that's going to have real world effects in America, because we're going to have to make up that loss of income, because it really is a source of income that we have had since the 70s, and it's really led to a lot of American prosperity. It was actually a great deal on our end, honestly. Like they made the deal in the 70s, and it has helped the Americans quite a bit. But again, that is in flux right now. It's somewhat in jeopardy, and something that needs to be paid attention to. Okay, so what is like the price of oil at this point? So this is Brent futures. So this is European oil, WTI, West Texas Intermediate. This is the futures price. Oman, Dubai, Platts. These are all futures prices, right? And we see that it's roughly somewhere around 110, 120, somewhere in that range. But then you look at the actual physical barrels and the delivery for physical barrels of oil. So the stuff that is actually making it off the tankers and vessels and whatnot, that is costing 160, 160, 170 for a barrel of oil at that. And so there's a disconnect. So the physical prices are a lot higher than the futures prices. Reason being, futures prices can absolutely be manipulated. This comes from people trading it up and down and doing all types of strategies and whatnot. But eventually, what ends up happening, and it ends up happening quite frequently, is futures prices tracks the delivery of the physical asset. So those numbers, when those numbers are different, the futures price, so whichever one of these is going to chase the physical price. So what I'm saying is, I expect the futures price to continue to rise, and that's going to have implications for us at the pump. And we'll talk a little bit later about how high I think things could go. But for right now, there is a major pressure for these to continue growing, especially as these continue to remain elevated. That's the reason that I said that the longer that this thing holds out, the more severe it ends up getting. So we'll see. We'll see how that ends up turning out. But that is my projection for the futures prices. Okay. And speaking of futures, this is light crude oil. This is crude oil WTI. This is the American futures contracts. This trade out of New York. This is going all the way back to, we see 1999 and current day 2007. So throughout the early 2000s, there was a gradual buildup of the price of oil, and this is a monthly chart. I'm sorry, this is a weekly chart actually. We see like it pretty much kind of went up until 2008. It peaked somewhere almost $250 a barrel, and then 2008 you have the great financial crash, and then it kind of it didn't really go anywhere for years and years and years. In 2014 there was another oil crash that took us into 2015, and then for years and years and years to stay in the same spot. Then you had COVID, and for different reasons. COVID was definitely an interesting one because like the price of oil actually went negative. The futures price actually went negative for a bit just because there was an extreme oversupply. Right now we are in a bit of an undersupply with 20% being lost, but COVID was the opposite. They were long about 20 million barrels a day. We are short about 20 million barrels a day at this point. So at that point, that leads to prices rising. So time goes on, oil down here is sustainable. That's not real. People are in their houses, but as the world starts to open back up, price comes here, and you see that this was the Ukraine and Russia conflict that really kind of drove price up here. But eventually, that settles out, and then boom, you have the Iran conflict. With Israel and the United States. And then we see just price absolutely take off. And it is now above average. This red line is the 200-week moving average. So, that's a very significant benchmark. You have zero here, the post-COVID floor, as we talked about. And then we shot up to here again. So things are, uncomfortable at this point. We see rising gas prices. We see diesel prices going up. It hasn't quite hit food prices just yet. It's uncomfortable, but it is manageable. Again, it depends on how long we stay up here. Is it a blip and we just go back down here? Personally, I don't think so. I think 100 ends up being your new floor. If you keep going up, okay, now you've hit hard times globally. This is when you start seeing food shortages, diesel shortages, your petrochemical end products, so your plastics and all that, that gets squeezed pretty hard too. Those prices go up. And then 200, you're just in a full-blown economic shutdown. We see that we don't stay above 200 for very long. Like you will end up having some sort of demand destruction at a certain point to where, hey, people just can't afford it. If people can't afford it, they stop using it. Once they stop using it, the demand goes down and then it reaches some new level. Usually there's some policy that comes in place afterwards, whatever it may be. But my thoughts at this point is, hey, we probably will hit 150. I already talked about on the previous slide that we're already at 157, 167 on Middle Eastern crude oil. Now, American crude oil does have somewhat of an advantage in that we're in a quote unquote safe zone. It's a lot easier to get to at this point than it is the Middle Eastern, but still, I do believe that we'll see 150. I think we'll see at 150 at least. We may even for a second hit 200, but I think we level out somewhere between 100 and 150. So yeah, again, you don't have a crystal ball, but it really depends on how long this conflict lasts before a resolution is reached. But I think at the end, you see what you form. You have a run, then you form a floor. You have a run, you form a floor. You have a run, you form a floor, and I think we end up forming a new floor somewhere around here. But again, that's to be determined. We'll see how this all shakes out as the weeks go by. Okay, so this is my favorite slide. Actually, I really like this animation. This is a distillation tower. This is really how the whole process of making gasoline is made. I'm actually, my background is chemical engineering, so I have worked in refineries. I've worked in petrochemical plants that utilize this technology to be able to transform crude oil into usable products that we use every single day. But essentially, what happens is, you take the crude oil that is pulled from the ground. You've extracted it, pulled it from the ground, and we put it in tanks. They pull the crude oil from those tanks and send it to a heater. Basically, they use steam and a fired heater, steam or a fired heater, to heat this crude oil up to, I don't know, let's say like 800 some degrees. Um, and essentially, what happens, they send this super hot stream into this tower. And as you go up the tower, vapors tend to rise. Again, they've made this thing boiling hot at this point. So the vapors are coming off of it, the liquid is going down. As you go higher in the tower gets cooler. As you go lower, you get more heavy material. There's lighter material up here. And then you have your intermediates in the middle. So ultimately, they do some other chemical processes to it. They may add hydrogen to the streams to remove sulfur. They can do cracking units, which essentially is taking like the longer molecules down here, these long chain hydrocarbons, and essentially cracking them into smaller hydrocarbons that end up in diesel and kerosene and gasoline, so on and so forth. Propane and butane, this is considered to be naphtha, if you've heard of that. A lot of your light end gases will go out here. And then these are your heavy fuel oil. This is used in ships. This is used in trucking primarily. You have jet fuel, waxes and lubricants, all sorts of stuff. So if you need an oil change, that's where this comes from. Um, Asphalt. So crude oil is it's very important. It touches really everything that you use on a daily basis. I'm not exaggerating. It's like 90 something percent of all the things that we use and touch have come into contact at least with a product that is made from crude oil. It's not an exaggeration to say that the world truly does run on crude oil. And this is looking at, and we talked about some of these refined products here. So propane, gasoline, kerosene, diesel, fuel oil, ship oil, so on and so forth. This is a map, and this came from, I want to say it was the IEA, which is your International Energy Association. And Goldman Sachs as well. They looked at the different countries and saw like who gets affected the most if the Middle East does not send out oil. And this hypothetical shock assumes zero flows from the Persian Gulf indefinitely. Now it's not going to be indefinitely, but this is just saying in that hypothetical case, if there is no more oil out, who gets hit first? So what I see here is Asia gets hit very hard. And I talked about in the beginning, Asia gets hit very hard. So you have China, India, Japan, South Korea, who are in some cases 100% dependent on imports for their gasoline, their diesel, their jet fuel. So this is a nightmare situation for some of them. Like countries like Sri Lanka, which really don't have the oil and gas infrastructure, they really get hit here. We see fuel oil is the one that is most affected, and again that kind of depends on the grade of oil that's being produced. But United States of America, I want to say thankfully, like it doesn't really affect us as hard because we are the number one exporter in the world of crude oil. Coming from Texas and Louisiana, California, Alaska, all these major hubs, Gulf of Mexico, we have the capability in America to be able to sustain at least without dealing largely on imports. And a lot of that came in around 2015, 2016, during the shale oil boom in Texas, out in the Permian Basin, over in what's that, Midland, Odessa. We're really self-sufficient. So 1% gasoline, we'd lose 3% of diesel. Really would lose a lot on fuel oil. And again, the Middle East crude is very important for running fuel oil. Naphtha, so these are your gases again. So again, America takes a hit, not a huge hit. Shipping definitely takes a huge hit, but there will be other implications for sure. Europe, I've heard in the UK at this point that they are already canceling flights, a lot of flights for the summer. Germany, France, Turkey, they don't get getting hit as bad, not nearly as bad as Asia. You see places like Singapore just absolutely get decimated and stuff like this. South Korea, Malaysia, Nigeria is chilling. If we look at Africa, Nigeria is fine. Realistically, they a lot of Nigeria's economy is centered around oil and gas. Like it is, right off of the coast of Nigeria, they have a lot of rigs and whatnot. So they have a lot of self sufficiency. The crude oil that they produce is able to be um, refined into all of these products, and it doesn't really hit them as hard. But the big thing to note is, like, again, the majority of the world's population. You talk about India, China, Japan, it rests in Asia, and so a lot of them are getting hit the hardest. So there will definitely be implications for this. There will be implications just because, like, we're sheltered, does not mean that we won't see the blowback that comes from this. So um, the stuff that I talk about in here, I see it as being. I'm talking in general how it will affect, but I do believe that the U.S. will be somewhat spared from some of the greater effects that you see other countries suffering, unfortunately. Okay, so what is this? I talked about refineries and refining earlier. We talked about what they make and how they make it. So, and this the next slide is how they make money. So right now, this is your 3-2-1 crack spread. If I had to sum this up very quickly, this is your refinery profit margin. So when this number goes up, refineries are making a lot of money. So your Exxon, Chevrons, BPs of the world, they're making a lot of money when this line goes up. And essentially, it basically says, 3 barrels. When we talk about 3-2-1, 3 barrels of crude oil should produce 2 barrels of diesel and I'm sorry, 2 barrels of gasoline and 1 barrel of diesel. And again, whatever the price of those 2 barrels are, the total 3 barrels, that's what your margin is. So at this point, diesel is getting very expensive. It's in short supply. So the people who make diesel, refineries, they get paid quite a bit during times like this. So the price of crude oil and diesel has risen, but the price of diesel has risen quicker. So I believe that refineries and people who operate refineries, companies who operate refineries, are going to see huge profit margins. I'd say definitely in the next 6 months for sure. Because even if you restarted everything today and all peace talks were made and we handled it, there's still going to be several months, if not years, of getting things back online before you're able to get back to full capacities because stuff has been damaged. And that's just a fact. But for right now, I see where people who operate refineries specifically as one of the big winners in this. Okay, and I said earlier, petrochemicals are contained in 95% of all manufactured goods. That's what I want you to get from this slide. I don't care about like all the word and stuff in here, and the different compounds, but that top line says petrochemicals are contained in 95% of all manufactured goods, and that is true. It's absolutely true. I don't think people realize just how much crude oil and petrochem touches their daily life, but it does. So we look at the bottom here. You have crude oil, natural gas. You have naphtha again, which is your gassy compounds, ethane, propane, methane. These are your main petrochemical feedstocks, um, and they go on to make ethylene, propylene, butane streams, and then you have your aromatics over here. So benzene, toluene, xylene, and then as it gets smaller and smaller, more specific and more specific, it basically makes up every compound that we use on a daily basis that we really take for granted, but it does all come from food. And that's just it's just a fact. It has made our world significantly cheaper. There have been drawbacks for sure, but I mean overall, it has enhanced the quality of human life more than almost anything in the last 100 years. I could say that with pretty good confidence. So what does this do to the U.S.? Like, how does this affect us? The main thing that most people look at from year to year is inflation. So, as things get more expensive, inflation goes up, and they basically calculate inflation by looking at what is the cost to the average consumer. Your consumer price index, they weigh a basket of different items and they get the averages and do whatever type of mathematics they need to come up with an index. And if crude oil gets more expensive, that means transportation gets more expensive. That means packaging gets more expensive. I haven't even talked about like the other downstream effects of crude oil being your big producer of fertilizer and all this other stuff too. There's a real effect on consumer prices. So I see this as probably increasing inflation in the short term at least. And that leads to stagflation. So I got on the slide like this is Jerome Powell's nightmare for sure. Um, you got a textbook stagflation situation here. So you have high inflation, You have weak or stagnant economic growth. We haven't really seen a whole bunch of growth in the last several years, and especially when you take away the money printing that we've done. Q4 of 2025 was the slowest quarter for GDP all year. And then you've also had labor market weakness. So if you look at the charts of the labor market, they peaked in 2022. There was a huge hiring frenzy post COVID that lasted up until early 2022. And then it's just been a slow, gradual decline since then. Um, so that makes it very hard for the Federal Reserve to either raise or lower rates because you have two options. You can raise rates, but at that point, if inflation is already high, that makes the cost of things even higher because now the cost to borrow money is higher as well. So if you raise rates, that's not really good for most people, but realistically, it probably is the thing that needs to be done. If you lower rates, okay, while inflation is already high, at that point, that that increases the rate of inflation because money gets cheaper. It's a short-term band-aid that kind of helps to ease the pains a little bit for prices, but it does not really fix the problem. Um, so in either situation, you're either kicking the can by lowering rates or you are raising rates and dealing with the problem head on. My thought is that they'll probably pause rates for another couple cycles and then they may start hiking rates. Again, a lot of this depends on how long this conflict goes on. But we'll end up seeing. So, and this is going to change too because as it stands, Powell only has another month or two left. He has April and probably half of May, and then they are going to. Trump is going to replace him with I think it's Kevin Warsh to run the Federal Reserve. So it's one of those things where it's like their hands are kind of tied, but I think ultimately they will probably end up hiking rates. And earlier this year, when I was talking in January, I thought they were going to end up cutting. But again, so when something like this happens, you have to change your models and what your assumptions are. Okay, 2026. I always got to talk about like how the assets are doing, and see what it is. In January when I made the video, it was January 11th. I really talked about energy being a big winner this year, and for some reason, everything needs energy, and that's a fact. What has performed this year in the 3 months of 2026? First quarter, WTI crude oil, it's up 48%. The energy sector ETF, XLE, this is from State Street, that's up 30%. So the energy sector is up 30%. Gold is up 8.1%. It had a huge start to the year, a great January, and then by the start of February, it started trailing off. I'm perfectly fine with that. I still love gold. I love silver. That pullback was reasonable. I think it pulled back to about the 200-day moving average or 200-week moving average, something like that. And once that's done, it'll consolidate for a little while, and then it'll just keep going back up. I will be in gold for the remainder of a long time. I'll be there. I'll be here for a minute. S&P, Dow Jones, and the Nasdaq. I do not like the stock market. I do not like the stock market at all right now. I think it looks terrible. I think we'll probably there are periods in history where the stock market has really not gone anywhere for 8 to 10 years, and I think we're heading into a period like that. And what do I mean where that it hasn't gone anywhere? It'll still be moving. So it may run up one year, but then it'll run down the next year. Run up one year, then run down the next year. That is a complete difference from what we've had for the past 10 years, where post 10 to 20 years, honestly, post 2013 ish to current, price just ran up consistently. After we got out of the shadow of the great financial crisis of 2008, stocks just really took off and never looked back at this point. But I don't think that's the case anymore. I think we will start seeing some negative returns on stocks, and I think in short order too, because there's a lot of there was downward pressure that I'm talking about now that was not present in January. And a lot of this is coming from the crude oil situation. So higher prices for crude oil generally mean lower prices for stocks because again that acts as a tax on the consumer. And then finally, Bitcoin. Bitcoin is not having a great time, but I've said it always. Bitcoin, the same way I just said about gold, I will be in Bitcoin for a while. I think Bitcoin has several more months of either going down or consolidating before it starts its next leg up. So the peak was in October, is at 123. I think from here on out, it's just going to continue to downtrend for a while until it bottoms out. You have a halving in 2028 at this point, but my allocation would not be large in Bitcoin at this point. Same way it wouldn't be large in stocks. I'd really be focused on crude oil and metals. So gold, copper, silver. Um, we're really focused on the physical world at this point, the physical assets and commodities. Bitcoin is actually a commodity as well. I think the SEC is deemed it a commodity. I think it's going to do well over the next 4 years, but it's going to have a temporary drawdown. So we'll see how that shakes out. I still think Bitcoin's going to do great things by, um, in the next coming years. But for right now, this is not that period. Okay, what do we have here? So this is I talked about stock market and whatnot. This is the sector ETF. So here's like sector by sector, who's winning and who's not. Energy is crushing at 30%. Telecom, 28%. Materials, again, we're talking about the physical world, commodities, 9.3%. I think that's going to increase. Utilities, so we're talking about energy, electricity, power, water, real things, 7.3%. Consumer staples, real things, food and all the things that people need, 5.4%. Industrials, real things, materials, real estate, like all the things that are real. And this is my point here. And I've been talking about this for a while. Things that are real and scarce appreciate and value very. And we see from right now, for the first 3 months of this year, the main things that are winning are things that are real and things that are tangible. So there are seasons for everything. It's not always commodity season, and it has not been commodity season for I don't think for years, for probably about a decade. We're changing. We're changing that tune essentially. So what's losing at this point? Communication. Healthcare is dropping out. U.S. sector rotation. Consumer discretionary. So we're talking about discretionary spending has been cut. Financials. This is the banks. The banks are not doing great. They're not doing great. Especially if money becomes more expensive. I think that trend will continue, and I think this trend will continue throughout the year, at least for definitely for the next several months as this conflict gets resolved. But in the meantime, you want to focus on the winners. You focus on the winners and the people who are. I mean, this is your tech stocks and whatnot, telecom, information and all that. But outside of that, it is all of your real tangible commodities that are really doing the heavy lifting for the stock market at this point. So. All right. I've talked about previously. There were some oil shocks throughout the decades, starting in the 70s. Really, this has been the last 50 years. So, the OPEC embargo, basically OPEC, the Gulf nations. This is in retaliation to the U.S. Supporting Israel in a war that was a 5 million barrel a day cut. And what I want to look at here is like, what was the price of oil during that time? What was the inflation? And what was the S&P drawdown? So one thing to note here, every single oil shock has resulted in a massive drawdown on the stock market. Every single one. Every single one has made it so that the stock market dropped quite a bit. Then inflation rose as a result too. So peak inflation, 12%, 14%, 6%, 5%, so on and so forth, 9% in early 2022 as they were hiking rates and stuff. This second one is in $2026. So this was 1973 versus 2026. If we normalize this, right, that was $78, 153, 100, 214. We did hit that. COVID pandemic. COVID was a little bit different. Like I said, there was an extreme. These were all supply shocks. These were all supply shocks. There was suddenly a lower amount of supply than what was previously available. Now it's going the opposite direction. So this COVID was a demand shock. Again, everybody locked down. They're trying not to catch the virus. They're in their homes. They're working from home. They're social distancing or whatever it might have been. That really put a dent in the demand for oil. And I don't know if people remember. I mean, like gas was very cheap during that period, and a lot of honestly the world was cheap during that period. Increasing crude oil prices do act as a tax on the consumer for sure. But what am I getting from all this? So you have these different supply shocks. Every single one results in a major S&P drawdown. Everyone results in inflation because again it hits that CPI basket, and then then you just have usually different policy that ends up coming out of it and things. So it's a lot to pay attention to. But going back to this, I do not plan on being in a ton of stocks this year. It's just not going to happen. For me, at least, this is not financial advice, but it is absolutely my professional advice. as an engineer that this is something serious and it will have downstream effects because that's just what the numbers say. This is in my opinion. I'm just looking at the historical context of what it is and just seeing like what happened in the past and how do I expect this to play out in the future. So we'll see. Right now, year to day, the S&P is already down 9%. 7 to 9%. It just depends on when you pull it, right? And then peak U.S. inflation we'll have yet to see. We were on like a down track. Well, really, I don't even want to say downward track. We were kind of flat for inflation, but I see that going up if this continues to persist. All right, so I'm a firm believer that I'm not going to bring a problem unless there's also some type of solution with it as well. So who wins when oil spikes? Because just because the S&P or the stock market is going to go down does not mean you have to lose. Like there are going to be people who get absolutely decimated and chopped in half with their portfolio because they're not able to position quick enough. Who really wins? I talked about earlier refiners. Like, so anyone who owns the refineries, they're going to do very well while this conflict persists and even in the aftermath. So you have oil and gas, which consists of upstream, midstream, and downstream. Downstream is your refineries. Upstream is the people who are pulling the oil out of the ground and the natural gas. And midstream is how you connect it to. So whether it be tanking or pipelines, normally pipelines, being able to get that material from here to the downstream refinery. So upstream, Exxon, ConocoPhillips, EOG Resources, Occidental Petroleum. I've worked with all these people on different projects. I've worked with Enterprise for midstream, Kinder Morgan, Energy Transfer, Cheyenne. They're a huge LNG producer, liquefied natural gas. They're going to do very well because, again, energy source. Energy is going to be key here. Defense and aerospace. I didn't start the war, but realistically, we are in one at this point. The missiles have been fired, shots have been fired. There's already a huge demand for more from all sides. So these defense contractors and aerospace folks they're going to make a lot of money realistically. So General Electric, your Boeings of the world, Lockheed Martin, Raytheon, Northrop Grumman. Some people have opposition to investing in defense. That's up to you. For better or for worse, I do believe that the price will rise here. And then the other thing that you have is fertilizer, nitrogen fertilizer. I talked about it earlier. The main way that we get our fertilizer is through a chemical process called the Haber process. It basically takes natural gas from the ground and mixes it with hydrogen, as well as nitrogen that's in the air. 78% of the air that you breathe, or 72%. I think it's somewhere in the 70s. Roughly 75% of the air that you breathe is nitrogen, and another 21% or so is oxygen. And they basically take the nitrogen from the air, the natural gas, as well as the hydrogen, and they turn that into ammonia, which is your main source of fertilizer. So CF Industries, they are the largest ammonia producer. CVR Partners, LSB Industries, Nutrien, they make fertilizer as well. So that leads into agriculture, so on and so forth. So anywhere, you just got to look at places where the demand for something is inelastic, meaning that the demand is not going to change no matter what the conditions are in the world. So things that are absolute staples, those are going to stick. And the people who produce those things that are staples are going to win. So yeah, nitrogen fertilizer. Another one is any type of sulfur products. The largest source of the largest source of sulfur in the world comes from crude oil. It doesn't really come from anywhere else. So anyone who produces and manufactures sulfur products, I don't have this on here, but they're going to win too. Maybe I'll follow up with that. But there's so many downstream effects. Like this ends up hitting the helium market as well, which helium is used in manufacturing your chips for all of the AI and all of this type of stuff. So there are real implications here. You have had a major loss of molecules, 20 billion barrels a day worth of molecules that are just no longer present, no longer above ground at this point. They're not pumping them out the ground. They're still present. They're just not getting out the ground again to the people at this point. So those are your winners. Who loses? So when oil spikes, airlines are going to be losers. Obviously, they're one of their biggest expenses is jet fuel. Logistics companies, so they're doing ship. They're doing air travel, they're doing car travel. So diesel gets hit, jet fuel gets hit, shipping oil gets hit. As we've seen, I'll go back a couple slides. This one, we see what actually gets hit. And fuel oil, if we go down here to the average, all the people who are operating ships at this point, they're getting smacked. They're absolutely getting smacked right now. Jet fuel is the second highest. Diesel and naphtha, so your this is for the trucks essentially, and then gasoline. This is for your everyday consumer. This is second to last, and then LPG, liquefied petroleum gas, LNG, liquefied natural gas. That's hit at 13%. So basically, anything that has to do with shipping and logistics, there's going to be an additional tax on that, and that's just a fact. That hits their bottom line immediately, and this is why you see different cancellations of different air routes. I've seen it happening in the UK. I've seen it happening in Japan and other places like that. Petrochemicals, and I'm going to put an asterisk by this because certain chemicals will actually still perform. Again, it just depends on what the demand is. But petrochemicals as a broad class will probably not do the best during this downturn. The reason I say that is because I've worked in the industry before and I've seen what happens when price goes in the opposite direction. So if, look at this chart, right? This is a great time for petrochemicals, this whole slope down. I was working in petrochem since 2019, and I remember working, with petrochem in the refinery. When 2020 hit, the refineries lost a ton of money. They lost a ton of money. Petrochemical plants were absolutely raking in because their feedstock was cheap. They got cheap feedstock from refineries, and then as time goes by, it started shifting back more in favor toward refineries, and now we see it's going the opposite direction. So now refineries are doing well. The people who are producing your naphtha, gasoline, kerosene, so on and so forth. But the petrochemical plants, as a result, they have more expensive feedstock, which cuts down on the profit margins. So knowing who that is important. Like LyondellBasell is one. In terms of, I think they're one of the largest petrochem producers in the world. Eastman, Huntsman, Chemical. You just have to look at who's producing what. Consumer, we already talked about consumer discretionary. It acts on discretionary spending, so that's going to get cut. Like things like, hey, we already talked about travel, right? But your luxury purchases, that's going to be the first to go for sure. And then things like construction and housing, because that ties back into diesel. Anywhere where you have to use heavy machinery and use a lot of diesel, that's going to get cut. So position accordingly. Again, none of this is financial advice, but it is an attempt to kind of make, I guess it's a thought experiment, really, just seeing like where I expect things to go. So this is what I think the overall chain of events for quarter two ends up being. And again, this video is more so I'm taking it quarter by quarter, month by month, just seeing where I expect things to go overall. So number one is where we're at now. Loss of physical barrel, 20 million barrels a day lost for Hormuz closure. And then I've said it a couple times, your closure length decides how severe this thing gets. Number two, crude oil inventory is lower. So your SPRs, your strategic petroleum reserves and commercial supply will end up falling. So again, this is your fix. This is your Band-Aid. It does not actually fix the situation. All it does is kind of helps you to bridge along until you can get some type of solution or some type of peaceful negotiation. If that does not happen in short order, you move on to step three. This is when food shortages start to begin because you lack both fertilizer and diesel. Again, we talked about any type of industry that is dependent on heavy machinery, that's going to be a tax. So farmers get hit very hard here. Your fertilizer gets more expensive. The diesel to run your trucks and tractors gets more expensive. The shipping cost to get it from your farm to the market gets more expensive. So you have a lower yield because there's less fertilizer. You have more expensive transportation costs. You have more expensive operating costs. Eventually, that does lead to food shortages in pretty short order. And I said this before. In America, we are insulated from this more so because we do have a huge supply of crude oil. But more affected countries like in Asia, oh yeah, it's going to hit pretty quickly. And that'll have broader implications, whether it be a refugee crisis or whatever it might be. That's kind of your next step. And then eventually, if crude oil continues to sail past 150 or 200, you do end up having some type of crude oil demand destruction through price. In that instance, like, if crude oil is $200 a barrel, that's going to have implications at the pump. If you have $10 a gallon on gasoline, that's going to stop a lot of people from moving. People are going to be less likely to hop in their car or catch that flight or do whatever. Eventually, those supply and demand dynamics, if there's less demand and a fixed supply or maybe increased supply, that comes back down and then the price comes down as well. So we'll see how that goes. That's step 4. Step 5, inflation forces higher rates. And, 4 or 5 can be kind of intermixed. This is what I talked about earlier with Jerome Powell being the one who decides what the rates are, your Fed chair. Central banks are going to want to keep rates elevated because they want to keep inflation as low as possible, but now they're in an impossible situation. So we'll see how that goes. I don't know which way they're going to go, but I think they're going to lean towards raising rates, realistically. And then, again, I don't think these are necessarily in order, but rate-sensitive assets fall. Like 4, 5, and 6, those could happen. 1, 2, and 3 are pretty in order, but like these could happen in different order. So rate-sensitive assets end up falling. So you have stocks, crypto, risk assets. Risk assets tank. Housing markets is further strained because it's already strained at this point. I do think we'll start to see housing prices come down as a result of this. I'm not saying that that's what you wanted or anything, but it's just an effect from a cause that started about a month ago. So that is my outlook for 2020. Well, Q2 at this point, somewhat grim, but it is realistic, and that's what I'm here to do, is to be realistic about it, and do the things that you can to help yourself out. So whether that be positioning yourself in the stock market accordingly, or making sure that you have proper food in the house, like. You want to get into the grocery store before the lines get ridiculous and the shelves start getting cleared. Again, I'm going to say this again. I do not think that we're going to get hit as hard on the food side in America, just because we produce most of our fertilizer here in America. We're not depending on other countries for fertilizer. So that helps us out quite a bit. Diesel will take a hit, so things will get more expensive for sure. But I don't know if we'll be hit as hard in America with the on-food aspect. So that is good. But there will initially probably be some type of panic, which could lead to shortages at the grocery store, just like we saw in COVID with the people buying toilet paper and whatnot, things that don't necessarily make sense, and having a reaction that elevated above what the situation actually calls for. So you just want to make sure that you're prepared. I mean, this is the point of this isn't to scare anyone, but it is to give a heads up for sure. So I think that's about it. Yeah, I think that's it. Yes, I mean, definitely any questions, by all means, always hit me up. But hit me up on Chris Talks Crypto. Check out any other videos on christalkscrypto.com. I wasn't seeing on the moon, but that's not quite the message here. Definitely stay safe out there and position accordingly. So other than that, y'all, take care.